Now, without further delay, let's begin today's event, sponsored by LexisNexis Risk Solutions and hosted by Digital Insurance. I'd like to introduce your moderator for today, and that is Pat Spear. Pat, you have the floor.
Thanks, Alicia, and thanks to all of you for joining us today. Our topic addresses one of the most important and challenging areas within an insurance organization. That's claims and customer retention. I think we'd all agree that insurers have faced an uphill battle when it comes to claims satisfaction, right? Not just because of technology issues, but because the customers come to expect instant information, instant solutions, and claims resolution in almost real time. We also know that customers are fickle, which means that if they don't experience a resolution quickly, they'll simply and easily shop for another insurer. Our speakers today are going to address this key point by providing some newly released independent research results that speak to the importance of being able to quickly and efficiently access and leverage the right data and analytics. They're also going to talk about the impact of claims severity as it relates to time to first payment, and the impact of claims processing speed and accuracy as it relates to the customer shopping for another insurer. Before I introduce our speakers, I will remind you that, as Alicia said, we're going to save some time for Q&A at the end of our program. But if you think of a question during either of our speakers' presentations, please don't hesitate to type it in the question queue, because we're going to try to get to as many of your questions as we can. Our first speaker is Patrick Sujin, Vice President of Analytics, LexisNexis. Patrick has more than 25 years of experience specializing in the effective application of leading-edge analytic technologies to the insurance sector and other industries globally. During his career, he developed and implemented new data and analytics solutions for P&C and healthcare claims, as well as life insurance. Prior to joining LexisNexis in 2000, Patrick led an analytics team as a member of senior management for a small startup that grew to more than 150 employees. Patrick has a master's degree in predictive analytics from DePaul University and a bachelor's degree in economics specializing in econometrics from the University of Chicago. Following Patrick, we're going to hear from Frank Cesario, Director of Claims for LexisNexis. Frank works with client engagement and product development teams to meet customers' needs and brings more than 16 years of experience in claims to his current role. Prior to joining LexisNexis in 2016, Frank served in claims management and investigation for Geico and Progressive. He also spent more than 15 years in the criminal justice field. Frank has a bachelor's degree in criminal justice and a master's degree in counseling from the University of South Florida, and also holds CPCU and ARM designations. All right, so without further ado, let's get started. I'm going to hand the floor over to you, Patrick.
All right. Yeah, this is actually Frank, and I want to thank everyone today for joining us. Today, Patrick and myself, we're going to be talking to you a little bit about identifying actionable insights in your data. The landscape of the industry is changing, and the assumptions that we had even just 5 years ago are completely changed and different than they were as far as severity and frequency. And a lot of this has to do as we adapt to what consumer demands are and the changes in technology. We see a lot of internal use of data. But internal data alone is not going to be able to paint the picture, and with the accelerated rate that we see these changes, it's not going to help us in our race to resolve the claims. What we are looking at today is what we can see not only within internal data, but what type of external data can also help with these issues. It really is about finding the right data at the right time to make all the difference for the world of insurance. We're going to look at different ways that these trends can not only identify what's occurring today, but also help us identify where we're going. But what are those items that help with those changes? Where can we take this information and be able to understand that what type of internal, external data can we apply that will also help us in the future as we mold the way towards more immediate service for the customers? But this is going to be a new way to really look at the data. We tend to see a lot of trends in the industry, and some of this is going to be familiar, but just to level set, the way that we're looking at this now is slightly different. We're going to use the policy shopping, claims history, and police report data that we have in-house. Now, this data is available to over 90% of the market, and we have almost 95% of all policy data. It includes 350 million claims reviewed, 8 million police reports, and up to 3.5 billion shopping events. To put it another way, we're really looking at a lot of data. But the data that we're going to look at today is going to flow in a way that you'll be able to see how we came up with it, but also look at what it does when we implement certain areas of the claims process, and we help with data in those areas. The next thing is when we look at any of these numbers, and you're going to see some charts that Patrick's going to talk through. These charts are based on an aggregated level by coverage at a claim level. So it's all in. So when you see these numbers, that's what it represents. And anytime you see cycle time, it's based on the date of loss. Whether we're talking about first payment or closures, it's going to be about date of loss. So with that, let's take a look at a picture real quick. I'll give you a second to take that in. I mean, that really could be anything. It could be the sun. It could be stars. It could be a lot of things. But I'll give you a hint. Each one of those dots is representative of a customer or a carrier in the insurance market. The interesting point is that the red dot, that's going to be your average. And when we look at this, what we see is in these groupings, yellow and blue. Well, the yellow is going to be your standard carriers, and the blue is going to be your non-standard carriers. We see this in the data. The interesting thing is when you start cutting the data into different areas, in this case bodily injury, it's easy to see how some are implementing some items that are really improving their processes, and they're making definite gains against the industry average, and you can see where that separation occurs. And then you can identify in those groupings what's really going on. But the question that we get a lot of times, and we speak about this in different areas, is that what does it really mean? And even more important, which one am I? So what we're going to do today is we're going to go ahead and look at these trends and understand how we've come up with these different areas and what we can show in the numbers. And that's Patrick's expertise. So I'm going to turn it over to Patrick now so that we can talk through that. And then I'll come back and be able to give you a little deeper dive into how some data can really impact the experience of not just the carrier, but the customer as well. Patrick, I'll turn it over to you.
Okay. And thanks, Frank. And so as Pat and Frank just mentioned, I am Patrick Sujin. I'm a VP of Analytics here at LexisNexis, working in the claims area. And I know as the quant guy, we analytics folks have the reputation of talking in as monotone a voice as possible about our exciting statistical analysis. And I know webinars can be a little difficult to follow sometimes because they're not quite as interactive, but I'll certainly try not to do that to make it easier to follow. But we are going through quite a bit of material, and we're going through it fairly quickly. So I do want to reemphasize the point that Pat made at the beginning of the presentation. That is, you're certainly welcome to ask questions that we'll try to answer at the end of the webinar. But also, if something comes along the way, one of the things we've seen is that people are interested in getting in touch with us after the webinar entirely to ask some more detailed questions about their particular piece of business, and we're more than happy to do that as well. So I wanted to put that out there. So the first thing that I'm going to be covering is what data and analytics I'm going to be talking about today. And this is really to reemphasize some points that Frank made, but one of the things that I find a lot of fun about working at LexisNexis is we really have a great deal of very unique data assets which allow us to use our analytics to come up with a great deal of unique insights about the industry and about specific carriers that we can share. And so to talk first about the data and then some of the philosophy behind the analytics we're going to show, the data we're utilizing for purposes of today's presentation are the types of things that Frank talked about and really kind of core material to the claim space. So, for example, we have a contributory data asset of virtually all the claims in the United States that were utilized for a lot of this analysis. We have, as Frank mentioned, policy data sets, which contain the vast majority of policy information in the United States. We have police report data, which contains a lot of the police report information about individual claims that happen, a large percentage of those. public records data, which has bankruptcies, liens, judgments, other types of things on individuals, as well as vehicle data. And then we have a very strong entity resolution tool, which allows us to take all these very disparate data sources and combine them accurately so that we can be sure that we are talking about a specific type of entity, whether that's an individual, a vehicle, or something else, and all the data associated with them as we do our analysis. So we're really using not just individual data sources, but combining these data sources together to gather insights that really aren't available anywhere else because of these the unique data resources we have. In terms of the analytics I want to talk about, there's a couple things I want to mention before I dive into it. One is that we're going to be showing a lot of trends, industry trends, carrier trends, and those trends are sometimes material that we certainly heard are unique trends that individuals haven't seen before, but they're sometimes also just trends that we fully expect that you see in your core book of business now, and we're really just trying to show these to show that these trends that we see represent what you're seeing in the work you're doing today. The other thing that I want to mention is that if you do have any questions, as I mentioned, about the analytics, please let us know. We are very much just trying to show some of the techniques and capabilities that we have. And so we are expecting that while this is an initial overview of some of the types of things we're able to do with this data, it, for obvious time reasons, is nowhere near all the insights that we can provide. And we will be following up in later installments with some additional findings that we have. So we thought we'd start this off. So I'm going to walk through some of the analysis that we've done here and how we go about approaching this and some of the tools and techniques we have and some of the capabilities that we have. And we thought we'd start with something that's pretty straightforward, and that is a known problem within the industry. And we're looking in this case at bodily injury severity and how that has changed over time from the first quarter of 2014 through the first half of 2017. And so what we're doing here is we're looking at the average severity payments over time, over that time period. And what we see is something that I really expect everyone would expect to see, because most people we talk to are seeing this in their own portfolios. And that is that the severity amounts are increasing very dramatically over this time frame. We're seeing a 17% increase in severity over this particular time, bodily injury severity over this particular time frame, which is obviously higher than the rate of inflation and higher than the rate of medical inflation. So something that we can see utilizing our data sets that we would expect most people are seeing within their own portfolios. And we think shows that the value of our data and being able to validate the types of things you're seeing in your own book of business. One interesting thing about this, though, is that we do see it's not just a straight line increase, but we see some seasonality in it as well. So in particular, some spikes in some third quarter severity payments. And that's one thing we'll note along the way as well. It's not just overall trends, but different types of things we're seeing within the data, not all of which we necessarily have a perfect explanation for, but that we'd be presenting to you as members of this particular marketplace and seeing what thoughts you have as these types of things occur. And so that's a way we wanted to start off, talking about an area, a known problem area, bodily injury severity, and how we're able to utilize our data sets to track what's happening with it over time. But we thought we'd then break that down and show some additional breakouts that we can do on this data. And we thought we'd start by breaking this down and showing how we can show severities not just for the industry as a whole, but within particular states. Because as we all know, the claims trends are not just national trends, but there's 50 different states, all of which have their own unique situations, their own unique details. And it's often desirable to drill down and look within what's happening within a state, not just the industry as a whole. And so we thought we'd start off by showing what an industry severity, bodily injury severity trend line looks for Georgia compared to the national average. So what we have here, the blue line is the trend over time for Georgia severity, and then the orange or red line is the trend over time for the national average. And we chose this example for a couple of reasons. One is that we know that Georgia is a state that has its own complications, that it's very common for Georgia claims to be more severe and cost more in settling. And we wanted to show that this type of analysis off of our data shows something that you probably see within your own portfolio, that Georgia is more expensive than the national trends. The other reason we wanted to show this is I happen to live in Georgia, and my rates are higher as a result of this particular trend, and it gives me a chance to get on my psychology couch and complain to several dozens of people or my closest friends on the webinar about my insurance rates. But the point of this slide is not necessarily just to show that Georgia is higher than the national average, but to think about it in these terms. This is a capability, something that we can do with this data. And if you as a carrier are having a problem within a particular state, like say your severities are climbing in Texas, and you're not sure if that's something that's just unique to your particular portfolio or it's something that's happening to the entire industry, and you're trying to explain that to yourself, to your boss, to your company, we can help use the data assets that we have to drill down into these types of analysis and tell you if there's something that's happening specific to you, if it's something that's happening in the industry as a whole, if it's something that's happening with that particular state, and help you understand better what's going on in this particular field and help you explain it to yourself and the people around you. Which brings us to the next point. One of the things that we think is very strong about these data sets is the ability to do not just industry trends or even state trends, but the ability to do what we call benchmarking. So that is the ability to look at how you as an individual carrier compare to others. So compare to, say, for example, a national trend or a state trend. And so this is an example. This happens to be a fictional example because obviously we're not going to share any specific carrier's data in a webinar like this one. This is an example of comparing what it might look like if we compare a individual carrier's data to a national trend, with the red line, once again, line being the national trend and the blue line being an example of an individual carrier. And using this type of data, we can use the fact that we have these contributory assets of all the claims in the United States, or almost all the claims in the United States, to be able to compare an individual, let a carrier compare themselves to what's going on as a national average or a state average or whatever the case may be. And we think this is definitely a very powerful capability that we see a lot of interest in as we talk to individual carriers. And so it's another way for us to break out the data. What I wanted to move from here, these examples have really been about bodily injury severity, and how that relates specifically to claims data. Well, what I wanted to do is show what we can do by bringing in other types of data. In this particular case, bringing in policy data. So what can we do, not just off the contributory claims information I talked about? What can we do if we combine that claims contributory information to policy information? And we thought we'd start once again with a pretty straightforward example and show some of the trends that we can do for combining those two data sources together and take a look at what's happening to severity trends for claims on standard book of business versus severity trends on non-standard book of business over the same time period, 2014 to the second quarter of 2017. And what we see here is that the severity line for the standard book of business is increasing in much the same way as the national severity line looked at in the prior graph. And that's probably to be expected. The standard book of business is really a large part and therefore drives a lot of the national trends, so that's not very surprising. But one thing that may or may not be surprising is that the non-standard trend that we're seeing in these particular databases is actually fairly flat. Maybe there's a little bit of an increase there, but it's certainly a relatively flat line compared to the rather sharp increases in bodily injury severity we're seeing in the standard book of business. And so one of the things that we start thinking about when we look at results like this is, why could that be? It could be that, and we could think of a couple of reasons. It could be that non-standard carriers handle their claims differently, or it could, for example, be that non-standard carriers have lower limits, and those limits are therefore keeping the severity more in line. And so we wanted to show an example of how we can do hypothesis testing to see if a particular theory holds true or not by using these types of data. and some of the drilled down techniques we have with these types of data sets. So we thought we'd show an example of how, once again, we can combine the claims data that we have with the policy data that we have and show what the severities look like for different types of limits to test the theory of do lower limits hold the severity increases flat, or is that just a particular feature in non-standard? So what this particular slide shows is what are the bodily injury severity increases for different types of limits, with the top brown line being the highest limit, so 250 and above, and the bottom green line being the lower limits, the state minimum limits, and the other lines being the various limits in between. And so what we see here is a pretty interesting trend that is pretty intuitive, really, I think, in that all of the bodily injury severity amounts do increase at a fairly rapid rate over this time period. But obviously the higher limits start at a higher level and increase to a higher level than the lower limits, probably simply because the limits are higher and there's more room for them to increase. But what we don't see is what we saw in this non-standard graph on the previous slide, which is this line being basically fairly flat. We see that even for the state minimum limits, that the increase is pretty significant, even though it is a minimum limit. So it leads us to the theory that on non-standard carriers, what's holding the severity increases relatively flat probably is not the limits, or at least not solely the limits alone, but also in how they do a lot of their claims handling. So this is really, once again, what we're really trying to do here is really more show capabilities of the types of drill down we can do, combining different types of data sets, such as claims and policy information, and some of the information it can show, and some of the thought process and analytics we can go through to test and resolve hypotheses about some of the types of things we might be seeing in our data, or you might be seeing in your data. And this is where we get a lot of questions about from individual carriers about things they're seeing in their data, and what can this tell us about that. So what I wanted to do from here is I wanted to move on, and I've been obviously talking through most of my slides so far about bodily injury severity, and that's certainly a big issue within the claims space within our business, so it seemed like a good place to start our focus. But I wanted to show some other slides that talk about different coverages and some different metrics. So what I'm going to talk about is property damage and collision, and not only severity, but days to first payment. And I want to show some results we have around that. Now, I do want to be clear, all the results I'm talking about in today's presentation are auto. So when I talk about property damage, I am talking about property damage to auto. This is not home damage. But there's a couple of reasons we wanted to shift to talking about property damage severity as well as days to first payment. And that is, first of all, is we wanted to see if the severity trends that we had talked about in the bodily injury, if those trends of rapidly increasing severity also held true for other types of coverages. But also we wanted to talk about days to first payment. And the reason why we wanted to talk about days to first payment is because we know there's been a large focus on cycle time within the industry, whether it comes from carriers making a shift to photo estimating, or any one of the other various innovations that's going on in the industry right now to reduce cycle time, increase consumer and customer happiness, and generally help develop a more positive claims experience. We know that there's been a lot of innovation, and a lot of carriers are focused on reducing cycle time and making improvements in that area. So what do we actually see as we look at our data? Well, what we see here is, and this is tracking a little bit of a different time period than the previous graphs. We're tracking 2015 through the first part of 2018. And what we see here are that we're seeing the rapidly increasing severity in property damage, much like we did with bodily injury severity. And that could be for a few reasons. One of which, for example, is we know that automobiles are becoming increasingly complex and increasingly expensive to repair, with sensors and a variety of other things being added to cars, repairs that might have been fairly simple superficial damage earlier, whether it's a mirror, a bumper, or something else, can now involve much more complex parts and be much more expensive things to repair. But it also could be other things as well. And the other thing that we see in this graph is that the days of first payment, particularly in the most recent year, is declining. So I think we do see that a lot of the innovations that are being talked about in the industry to reduce cycle time are in fact evident in the data we see, that first payment is going out sooner, and the days to make a first payment from a date of loss, as Frank said, are reducing over time. We also do see some seasonality in this, which is kind of interesting. Basically, fourth quarter seasonality with spikes in days to first pay, and we have some theories around that but certainly that's a conversation about what's going on with individual carriers and why that might be. But we certainly do see the property damage severity increasing and the days to first payment decreasing. One of the thoughts that we don't really have an answer to, but we can bring up is the severity, could the severity in part be increasing not just because cars are becoming more expensive to repair, but because could that also be related to cycle times being lower? Are claims being handled in a different manner that makes them somewhat more expensive to repair? We're not saying that's the case, but we are saying that we're seeing data with these two things going on, and we see those two trends occurring together, and there are multiple possible explanations for why that could be. Just to show another type of coverage, we thought we'd show this same type of slide across collision and not just physical damage. So here you really see the same type of story, same type of thing we saw in property damage, where there is, it's actually a little bit of a more cyclical line, but you definitely see the increase in severity for collision just like you did see for property damage. And you also see the reduction in days to first pay just like you did for property damage. So once again, just taking a closer look at that and diving in a little bit deeper and showing another type of coverage rather than just property damage. So I know that was a lot of slides on some different metrics, bodily injury severity and how that's been increasing rapidly over time, and some of the ways that we can cut that into more detailed slices such as by state, adding in policy data, looking at it by standard, non-standard, looking at it by different policy limit amounts, looking at different types of coverages such as collision, physical damage, and looking at different metrics rather than just severity such as days to first payment as a proxy for overall cycle time. But now I want to break in, and those are probably all metrics and thought processes and coverages that you're very used to dealing with in the claim space. But now, for the next couple of slides, I actually want to break into something that's a little bit different than some of those more traditional metrics and more traditional slides, and that is looking at shopping behavior and how that relates to claims. So first of all, shopping behavior is probably not something most claims people spend a lot of time thinking about. So let me explain a little bit what I mean by when I talk about shopping behavior and why I'm talking about it today in a claims presentation. What I mean by shopping behavior is individual customers looking and shopping not at the carrier they're currently at, but shopping at other carriers for checking out pricing and potentially thinking of switching to carriers, a different carrier to meet their auto insurance needs. And so the reason we're talking about that from a claims perspective is because we know a couple of things really drive people to shop their insurance from one carrier to another. The first is obviously price, and there's not a lot of that really comes from claims. But the second is the overall customer satisfaction with the carrier, a component of which is the claims experience and general happiness with the claims experience. So what we're going to show you is some of the statistics we see around shopping and how that relates specifically to claims experience and whether or not a claims experience can drive more or less shopping at individual carriers as a claims event occurs. So we thought we wanted to start off with just a straightforward slide, nothing to do with claims specifically, but a straightforward slide talking about what insurance shopping is. And this might be a slide that we show at an underwriting presentation, not just the claims one. And this slide looks a little busy, but it's really not that bad. It really has two main concepts in it. The top line is a slide that is a line that shows what has been happening with general shopping volumes over time from 2014 through 2018. And what we see here is that shopping continues to increase over time. So there's been a gradual but continual increase in shopping behavior from 2014 to 2018. So more people are shopping their insurance, looking for other insurance. And at LexisNexis, one of the things, and Frank alluded to this as well, we believe we have over 90% of the shopping behavior that goes on in the marketplace. So we have a very good and rich history to provide shopping behavior on. The slide that the bar charts below the red line are charts that show what is the percent change year over year of shopping activity for that particular quarter. So, for example, that 2.7% on the far left side of 2014 shows that shopping increased 2.7% in the first quarter of 2014 compared to the first quarter of 2013. And what we see really in this slide is it looks a little jaggedy, but what we see is that there's some quarters with fairly low but always positive shopping increases, so shopping is always increasing, and other quarters where there's very, very high increase in shopping behavior, as high as 8 or 9%. And so we do know that those trends correlate very closely to changes that we know are occurring in the marketplace. So basically, as carriers increase their prices or decrease their pricing, either one drives shopping behavior. We see these large spikes and large percentages in increase in shopping behavior as people see changes in their rates or opportunity to go to lower rates, whichever the case may be. So these all fit very, very much trends that are well known in the industry, continuous increases in shopping behavior and year-over-year increases by quarter in shopping behavior that matches trends that we would expect to see with the industry. What does that all mean for claims, though? One of the things that we can do, we've done a lot so far in showing trends over time. And one of the things that we can do is show trends not over time but in a round event. So specifically in this case, we can show trends around a claim event. So what, in this particular case, what we're showing with that dotted line, that dotted up and down line in the middle, is how did shopping behavior change before a claim occurred and after a claim occurred. And so rather than changes, from 2014 to 2018, this is the 90 days prior to when a claim occurred is on the left-hand side of that dotted line. And on the right-hand side of that dotted line is what happened in the 90 days after a particular claim occurred. So shopping around to event rather than over time. And what we see here, the straight line, the straight horizontal line at the bottom is what we would expect the shopping to be based on this particular group of individuals if no particular claim event happened. And so what this slide is showing us is that there's actually an increase in shopping behavior, people looking forward to shop their insurance, buy insurance from somebody else from their current carrier, even before a claim event occurs. Now, you might look at that and you might think fraud, but it's not necessarily fraud. For example, some legitimate things could happen. For example, a person could add a youthful driver to their policy. That could change their rates, and they could start shopping their insurance to look to see if they can get better rates. And then what do youthful drivers do? Well, they get into accidents. So there could be legitimate reasons why that starts to happen before a claim is lost. But then what we definitely see in this particular graph is that when a claim occurs, on the day a claim occurs, the shopping rate increases very, very dramatically. And we think that's very intuitive, although it may not be something we think about very often in claims. And that is because people get into a claim, they say, oh my gosh, my rates are going to go up. Let me see what I can do about getting new insurance before that gets well known and see if I can get better rates before this goes on my record. And then what we also see after that is that the shopping rate stays relatively high. So it doesn't go immediately back down to where it was. It's not a one day up and then right back down. But it goes up and it stays up for at least the 90 days afterwards. We also know from some data we've looked at that isn't in these particular graphs is that not all claims are created equal. A claim that is more complicated, more severe, actually has a higher shopping experience after the claim than a claim that is less complicated and less severe. So not all claims that are created equal when it comes to do they shop or do they stay shopping after a claim event. And we think that can very much be because more complex claims leave for more room for customer dissatisfaction and might leave more room for shopping. So how might that matter to an individual carrier? Well, one thing we can do is we talked about the ability to benchmark. We could take this shopping trend that's here and we can compare an individual carrier to how they compare to this overall national shopping line. And if the shopping experience for that particular carrier is lower than the national average, that might imply that in general that carrier is having a better claims handling experience and leading to less shopping out to other carriers than the national average. And if it's worse, obviously other ways. So these are just some additional things, some additional data we can bring into play, the shopping data along with the claims data we talked about, along with the policy data we talked about, bringing all three of those into play to talk about some additional insights that the industry can be aware of that probably most people in claims don't even think of all that often, that is shopping behavior afterwards. So I'm going to turn this back over to Frank so he can talk about some of the products we see out there and how some of these trends can be used to validate impacts of some of the products that exist today.
Right, and we'll also come back at the end to another example with shopping, which having worked in claims my entire career, I do find it to be really interesting what you can correlate from that information and how it can help understand what's really going on with your book of business. But in the case of benchmarking, it's really for this purpose. What we're going to be looking at is taking some information and seeing if our hypothesis about applying data earlier actually will play through and have a benefit in an overall strategy, because there's many different parts of it. But the excitement right now to get that customer experience up, to be able to integrate different types of machine learning and AI into your processes, and the ability to get the right data to make those right decisions is really where this benchmarking comes out of. So the first thing that we did, many of you may not have have seen, or many of you may have seen the study that we did earlier called More Data Earlier. And what we were trying to do is determine whether or not it would hold true the hypothesis that by integrating more data earlier had a benefit to the overall claims process. I think today we can all come to an understanding that that pretty much is the direction of the industry now, and it does make sense. But back then when we looked at it, we were able to come up with looking at over 400,000 third-party BI features and 1.8 million PD features. We took a look at it and we said, you know what? After review, it does look like there is a definite impact, and that impact included the cycle time. It included less attorney involvement, and I think we know with the trend in attorney involvement with bodily injury right now on a steady increase, it has not decreased since this study, that any benefit at all to that with more data to help you build that relationship with a consumer and to be able to work through the process so that they're satisfied is beneficial in that regard. And also reduction in expenses. And when we looked at that, we said, yes, this came to be true. We were able to prove that out. And even for things like your property damage, we were able to see where different fees were coming down. We were able to see quicker handling. So really, overall, we felt that that was a strong way to display that. Now, the question is fast forward to today. Can we show any type of information or data that has been integrated, whether or not this study was in fact correct? So what we did, we took a look at our suite of products, and we pulled out a couple that really hit on having more data earlier, much like the study. And the two that we fell on were police reports through Claims Compass and claims data fill. Now, on the first one, just to give you a quick overview of what each one does, police reports through Claims Compass delivers police reports. Simple enough, but it does so in an interactive fashion. So it's a system-to-system delivery. That means that it's not a manual process. You're getting that information relatively quick. And not only are you getting that, but it also delivers the data elements. Now that also provides the ability to ingest that information like we haven't been able to do before and use it, whether they use it internally for analytics or be able to take that information and apply it into their software, however they integrate it to help them make better decisions. This really comes in early in the process. So we went ahead and took that and said, okay, we know that that helps early in the process, but we don't want to just use one product to determine whether or not this was going to be effective. We also flipped it to claims data fill, and claims data fill really gets to the heart of being able to deliver information early, because it really is at first notice of loss. You're given a little bit of information. It could be a plate and state and a name and an address, And what it comes back with is party, vehicle, and policy information. So when you think about that, what may have taken weeks to get before, you're getting up front with the ability to then communicate with the customer. It speaks directly to the point of more data earlier. So we took that, and our analytics department, led by Patrick, were able to take that information and say, okay, what can we do with that now to show what it does when it's implemented? Well, the first thing that we saw was on police reports was an improvement on retrieval time. Whereas there was very little retrieval time on the early part, you can see a drastic improvement. But the histogram not only talks about the police reports of being improved rate early in the claim, but also after implementation, it made sense that once the adjusters had this information earlier, they were taking action on it. And we'll look at that in a minute as well to see if it really did help them. But the amount of time saved by the adjuster and the added value of the data for internal analytics, once it's received, would have a benefit. And you can see that this increase from 1 to 6% in just the beginning and 4 to 5 days up from 8 to 14% is a drastic improvement all the way to having at least 30% within those first few days. By taking this information, we said, okay, well, that's great. So the retrievals were faster, but what does it mean for the impact on property damage? Well, you can see when we bucket this, we looked at it on a 90-day roll, just to keep it a simple view. Prior to implementation, the results were more towards the negative end. They weren't as quick as moving along. So that bucket on the 90-day end had a lot more. But as you were able to implement, and as they were able to implement this type of a product that hits early in the process, it helps speed everything up. It helps speed their days to first payment up. So overall, I mean, if you look at this, this is overall an improvement of at least 4 to 5% in total cost early on in the process just by being able to move this. And a lot of that's probably speaking to storage fees, the ability to get to the vehicle quicker, towing fees. There's a lot of different moving parts to PD, which is different than collision. But when you take all things into account, every day you're waiting for a property damage claim is more and more fees accruing that you're having to work through. So it is really a benefit to have that. So both of these showed to some degree that we were able to move those buckets, and we were able to get those police reports quicker, and by doing so, it did help improve the outcome. But here's a different view of it. When you look at this, this provides an industry view compared to the customers that had earlier information. The gray bar towards the right, that's the implementation period. The interesting thing that we found when you put them all together and you line them up and you put it against the industry is look a little further back. There's that in and out. There's that struggle in and out of trying to keep up with the industry. Sometimes there's an improvement, then there isn't. It's that up and down flow that generally doesn't indicate that there's something consistent that's going to improve the overall impact. But look at the widening of the gap as you continue on. That tells the story that when you implemented something early on in the process and you use that as part of your overall claim strategy of obtaining data earlier or getting a little quicker at handling things, it has an improvement all the way through, which is consistent with what Patrick showed in his trend analysis as we looked at those type of patterns or what's going on with the industry. But it also, we said, okay, well, that was good for the first payment. Does it hold true as well as having an impact on the overall severity? Again, look at the trend earlier. It's that in and out. It's the not consistency. It's the constant movement of trying to fight off that industry average to finally, once we've been able to pull a product in and a strategy that really attacks early on claims handling, we start to see the opening up and the widening of improvement against the industry average. This is significant in the fact that you can see it from the payment, you can see it impacting the severity, and you can actually see how earlier data came into that mix and was able to assist in that process as they brought it in earlier. Remember, by getting it system to system and by able to get some of the elements and be able to review them, you're able to make decisions a lot quicker that you would have had to wait in order to obtain that information. So that's what we were talking about with property damage. But on the other side, we talked about claims data fill, which pre-fills information related to the party, the vehicle, and the policy to help give you information that you can make a decision on, whereas normally you would have to wait. So we took that product again, and the next thing we're going to look at, and we're going to shift away from the property damage side, we're going to move back to bodily injury. Does having more data earlier in regards to bodily injury and having the information about a party or a vehicle assist you in making better decisions and assist in improving the process? Well, looking at this one here, you can see that it reduces the need to chase down information. That's just because you're getting it system to system. But look at the way the improvement were for days to first payment. A 14% improvement was seen when bodily injury information was obtained earlier in the process. So that says that going back to the more data earlier study, it is very, very consistent with what was found back then. The numbers, the percentages, the way it was handled, the way we looked at it, it continues to be consistent. So the fact of the matter is looking at these improvements, this 14% improvement, that if you're able to do this, then you are able to make some headway into staving off some of those costs that we don't control. You can't control the medical bills. The medical bills are going to come in. They're going to be the medical bills on a bodily injury many times. There's some things that are just static, a hospital bill. There's a lot of things that are out of the hands of the adjusters. But what is in the hands of the adjusters is when they have more data earlier in the process, they can make the contacts to build the rapport, to work with the individuals to come to the best resolution for everybody. Now, looking at this, do we see that in the first payment, but does it really have an impact overall on the severity? It's great we were able to make payments quicker, but what did it really look like? Again, taking a look at all the customers that were involved with this, along with the industry, the gray area being the implementation area, it tells a similar story to what we saw with the police reports, where that also brings in more information earlier. As part of the strategy, of the overall strategy, by bringing in this type of information earlier, did it have an impact? And the simple answer is yes. But the question is that gap widens. What does it really mean? Well, in this case, it means up to almost like a 10% improvement over the industry. That's huge in overall days, and overall days closure in excess of 4 to 5 days on a decrease of 1 day for every one of these movements would be great. But this actually meant a 4-day decrease. So you were able to see that not just the severity improved, the payments improved, which means there's some communication going on there, which is what we want to see in the industry. Customers are really demanding that. Customers want us to be able to communicate more, communicate often, and be able to help them through the process. We all know how scary it is to have an accident. We all have had them. I've had them myself, and even working within the industry, it's still something that will unnerve you. You're looking for that person or that process that's going to make it easier. You're being taken out of your normal routine and having to go through something that you may not want to. Now think about combining that with the fact that after you've gone all through that, if you're our customer, you may also get a rate increase. How important is customer service at that point? Because customer service is going to really, really come into play. And what we see is on the same customers that were involved with these claims where there could have been an increase, the customers that were getting the data brought in on accidents they've had where there was a bodily injury, we actually saw a 15% improvement in the shopping rate. Now, there's other things that go into a shopping rate, but looking at it as a larger group and being able to see this trend amongst different carriers brought together to see that there is improvement when we implement earlier, that is very, very important. So I want to really focus in on that in a way that we really haven't looked before in the industry. In customer service, we see a lot of things, whether it be J.D. Powers, whether it be industry trends, whether it be internal things we're doing for service. But at the end of the day, your customer's experience can be really impacted, and you can view how well impacted by looking at these shopping trends. So with that, I'm sure we have plenty of time for a few questions right now that we could get to, and I'm going to turn it back over.
Thanks very much, Frank. And really happy to take attendees' questions, although we are coming up a little bit later on the hour than we had thought. So let's see how many of these questions we can get to. And just as a reminder to our attendees, if your question isn't addressed in real time during this event, know that someone will get back to you from the team because we don't want any of your questions to go unanswered. All right, so let's begin here. It says, how are you able to provide police report data elements? I think, Frank, you want to start with this one?
Yeah, I'll take that one. Well, one of the things that we do is we handle a lot of police reports, and by doing so, we're able to now integrate in a system-to-system fashion so that when you send a request for a police report, we're able to deliver that back to you in a system-to-system fashion, but not just the police report. You'll get an electronic image of the police report, but you also get the data elements along with it so that you can take that in.
Okay. Patrick, did you want to add a comment to this? Or
oh, sure. No, yeah, the only other... Yeah, that sounds great. The comment I would add from an analytics perspective is another thing the police reports data allows us to do, much like any data asset, is allows us to get another view into a particular claim, whether it's a view about the vehicle, a view about the person, a view about a different aspect of the claim. And it can really allow us to develop a much more in-depth and a much fuller view of the accident history and the claim itself from which we can create actionable data and actionable insights that allow us to take advantage of that specific knowledge. So it's really a very powerful source for claims and something that allows us to provide a much more well-rounded view of what's going on.
Okay, good. Thank you. Okay, one more question. Why is more data at first notice of loss critical to the metrics you've shown? How does that work? Patrick, do you want to lead us off on that one, or Frank?
No, Frank started.
Yeah, I was going to start up. But from a claims perspective, it's every adjuster, what area you work at, it doesn't matter, every adjuster. One of the struggles is not having the right information to make decisions early on, because those early on decisions drive everything else in the process. The longer a claim sits, the more dissatisfied that person you haven't contacted is. The more dissatisfied your insured is when you don't have the right information to make that liability decision or to dispatch somebody out to handle their claim or to make the right decision at the right time with the right data. And then on the analytics side for Patrick, I would say that one of the more important things is we see this in the numbers. The more information that we're seeing up front, it seems like through the results and the trends, everything else improves as well.
Right, and I think that's very intuitive. I mean, certainly if you talk to virtually anyone, they're very well aware that a longer a claim sits around you, there aren't good things happening from it from either the carrier or the consumer experience perspective, either one. We certainly see that in the data. Claims that take longer to close, are more expensive, costing more, even with, similar overall loss characteristics. So we're certainly seeing that, and we're certainly seeing, including in the results that Frank showed today, that when more data is provided to the claims handler up front, they're able to drive a lot of that cycle time down, a lot of that cost down, a lot of that customer satisfaction up.
Right. And I'm sure with with the claims triage, it probably really comes into play with FNOL, right?
Oh, absolutely. Oh, yeah, claims triage is a huge component. So deciding which track, low touch, no touch, high, getting a more experienced claims handlers on the claim is appropriate, are all keys to this type of more data early.
Yeah, and I think anytime you have that internal and external data, you really have to be on your game if you're going to be automating processes where triaging becomes just a smooth process. If you can't take them off the track or move them down the track with a level of confidence, and that really comes from having the right internal and external data and being able to use those resources, it's going to be a struggle. By having that, it really kind of smooths out the process.
Yep, great. Thank you. Well, we have quite a few questions in the queue. but I'm afraid it is time to wrap things up. For those of you who didn't have your question addressed in real time here, please note that a member of the team is going to be getting back to you, so all the questions will be addressed. I've put the contact information up here for our presenters, and as a housekeeping note, a recording of this event is going to be made available to all attendees. So I want to thank our presenters, Frank Cesario and Patrick Sujin, for sharing some great information with us today. I don't think we've seen anything like this just yet. This is new research, so thank you for that. And on behalf of Digital Insurance and our sponsor, LexisNexis Risk Solutions, thanks to all of you for joining us. Have a great rest of your day.
Thank you again for joining us. This does conclude today's call. You may now disconnect.